November 14th, 2022, 8:47 p.m. Tyler sat on the edge of his bed in Phoenix, Arizona. His phone screen glowed in the dark. Negative $143,000. That was his Robinhood account. But the real number was worse, because that money wasn't his. It was his house. How does a 34-year-old marketing manager with an $88,000 salary end up owing more than his home is worth? He did what millions of Americans are doing right now. He borrowed against his house to invest. This is his story. According to Experian, HELOC balances in the United States hit $359.9 billion in 2024. The average balance jumped to $45,157. And that number is still climbing. Tyler Mitchell grew up in Mesa, Arizona. Went to Arizona State. Got a degree in marketing. By 2020, he was making $88,000 a year at a digital agency in downtown Phoenix. Not rich, but comfortable. He and his wife Kayla bought a 3-bedroom house in Chandler in 2018 for $310,000. Put down 15%. Mortgage was about $1,600 a month through Wells Fargo. By early 2021, the house was worth $420,000. That's $110,000 in equity they hadn't earned. The market just handed it to them. And Tyler couldn't stop thinking about it. That money was just sitting there, doing nothing. In 2024, first quarter HELOC withdrawals rose 22% year over year to nearly $25 billion. That was the largest first quarter volume in 17 years. Americans are tapping their homes like ATMs. In March 2021, Tyler walked into a Chase Bank branch and applied for a home equity line of credit. A HELOC. The approval came back in 9 days. $120,000. Variable interest rate, 3.75%. His plan was simple. Take $60,000, put it into a mix of growth stocks and crypto. Ride the bull market, pay it back in 2 years, keep the profits. He opened a Robinhood account that same week. First month, he put $30,000 into Tesla, Nvidia, and a handful of tech ETFs. The other $30,000 went into Bitcoin and Ethereum through Coinbase. By June 2021, his portfolio was up 22%. He'd made over $13,000 in 3 months. On borrowed money. He told Kayla they were going to pay off the HELOC early. Maybe even put a pool in the backyard. At this point, what would you have done? Tyler did what most people do when they're winning. He doubled down. In August 2021, he drew another $40,000 from the HELOC. This time, he put it into riskier plays. Meme stocks, AMC, a crypto token his coworker recommended, leveraged ETFs. By October, his total investment was $100,000 of borrowed money. His portfolio showed $131,000. He was up $31,000 on paper. Then the Federal Reserve made an announcement that changed everything. In November 2021, the Fed signaled it would begin raising interest rates to fight inflation. Markets didn't crash immediately, but the mood shifted. Here's what Tyler didn't fully understand about his HELOC. The rate was variable. It moved with the prime rate, and when the Fed raises rates, the prime rate follows. Between March 2022 and July 2023, the Federal Reserve raised interest rates 11 times. Tyler's HELOC rate went from 3.75% to 9.5%. His monthly interest payment nearly tripled. January 2022. Bitcoin dropped from $47,000 to $33,000 in a single month. Tyler's crypto was down 38%, but he didn't sell. He told himself it would bounce back. It always did. February. The stock market started sliding. Tech stocks led the fall. His Tesla shares dropped 23%. Nvidia fell 19%. March. His HELOC interest rate ticked up to 4.75%. His monthly payment went from $187 to $396. Still manageable, barely. March 2022, portfolio at $89,000. June, $61,000. September, $43,000. His $100,000 in borrowed money was now worth less than half. But the HELOC balance didn't shrink. He still owed $100,000. Plus interest. This is the trap nobody talks about. When you invest your own money and lose 50%, you lost half your savings. When you invest borrowed money and lose 50%, you still owe all of it. Plus interest. On a rate that keeps climbing. Tyler started making minimum payments on the HELOC from his salary. But the interest rate kept rising. By December 2022, his rate hit 7.75%. His monthly HELOC payment was now $645, on top of his $1,600 mortgage, on top of car payments, groceries, insurance. His total monthly housing cost went from $1,600 to over $2,200. HELOC rates hit their all-time high of 10.16% in early 2024. A homeowner with a $50,000 HELOC was paying $423 in interest alone, every single month. Tyler's portfolio kept falling. The crypto token his coworker recommended went to zero. Just gone. $18,000 vanished overnight. His AMC shares dropped 91% from their peak. By November 2022, his Robinhood account showed negative $143,000 when he factored in what he owed. His investments were worth $27,000. His HELOC balance was $107,000 with accumulated interest. He was $80,000 underwater, and the collateral for all of this was his family's home. In a Bogleheads forum post, one investor wrote, "Borrowing against your home to invest in stocks will most likely be a recipe for disaster. If things go badly, you lose money in the underlying stocks and go deeper into HELOC debt at variable interest rates." Tyler sold everything in December 2022, got back $24,000, but he still owed over $83,000 on the HELOC. The rate was now 8% and climbing. He and Kayla sat at the kitchen table on New Year's Eve. No celebration, just a spreadsheet and silence. To put that in perspective, $83,000 is roughly 11 months of Tyler's gross salary. Before taxes, before rent, before food. Nearly a full year of work, owed to the bank with nothing to show for it. They tried everything. Tyler picked up freelance marketing work on weekends. Kayla got a part-time job at a clinic. They cut every subscription, sold the second car, moved their daughter to a cheaper daycare. For 8 months, they scraped together an extra $1,500 a month toward the HELOC. But the interest kept eating into their payments. According to the FINRA Foundation's 2025 National Financial Capability Study, more U.S. households are struggling financially despite stable incomes. Rising costs of housing, insurance, and everyday expenses are squeezing families harder than income alone can explain. By September 2023, Tyler's HELOC rate was 9.25%. The minimum payment was now over $800 a month. Combined with their mortgage, they were spending 62% of their take-home pay on housing alone. Then Tyler missed a payment in October and another in November. Wells Fargo sent a notice. Pay the past due amount within 30 days or the HELOC would go into default. Tyler couldn't catch up. In January 2024, Wells Fargo declared the HELOC in default and accelerated the full balance. They demanded immediate payment of $79,000. He didn't have it. Foreclosure filings were reported on 367,460 U.S. properties in 2025. That's up 14% from 2024. And delinquencies across all mortgage types, including HELOCs, have been rising steadily since late 2024. Tyler and Kayla negotiated for months. They tried loan modification. They tried refinancing. But with a credit score that had dropped to 540, no lender would touch them. In June 2024, they listed the house. It sold for $385,000. After paying off the first mortgage and the remaining HELOC balance, they walked away with $11,000. $11,000. From a home they bought for $310,000 after 6 years of mortgage payments. They moved into a 2-bedroom apartment in Tempe. Rent $1,800 a month. Here's what this story teaches us. First, a HELOC is debt secured by your home. If you can't pay it back, you can lose your house. Period. It's not free money. It's a second mortgage with a variable rate that can double or triple without warning. Second, investing borrowed money multiplies your risk, not just your returns. When the market drops, you lose the investment and still owe the full loan. There's no reset button. FINRA explicitly warns, borrowing against your home to invest is always risky. If your investment doesn't perform as hoped, you can lose the collateral supporting the loan, your house. Third, variable interest rates are a hidden time bomb. Tyler's rate went from 3.75% to over 9% in 18 months. Nobody plans for that. Fourth, home equity is not a piggy bank. Americans hold $34.5 trillion in home equity, about $302,000 per homeowner. That's generational wealth. Treating it like play money is one of the most dangerous financial decisions you can make. Fifth, if you're tempted to borrow against your home to invest, ask yourself this: would you take out a second mortgage to walk into a casino? Because statistically, that's closer to what you're doing than you think. Drop a comment right now and tell me. Have you ever been tempted to use your home equity for investing, or do you know someone who did? I read every single comment. If this video made you think of someone, a friend, a family member, someone who might be about to make this same mistake, send this to them right now. Subscribe and hit that bell. We do this every week. Take care of your money. I'll see you in the next one.